Happy Friday out there, folks. This is Darius Dale here to present our macro minute for Friday, July 1st, 2022. Starting with asset markets, we have stocks down this morning, commodities mixed with crude oil leading, crypto up, dollar up, global bond yields down. Market moving headlines. Sentiment is not positioning. You've heard me say that all year. Bank of America's bull and bear indicator remains at quote unquote maximum bearish for a third week in a row. Yet about $5.8 billion exit global stock funds in the week through June 29th. Even though U.S. equities saw small inflows, BofA said, citing EFPR global data, bonds had redemptions of $17 billion. So riddle me this. Everybody's at maximum bearish, according to this dang survey, but yet they're buying stocks and selling bonds. It's asinine. Let's move on. The market actually is the economy. So global companies pulled more debt sales in the first half of 2022 than they did in all of 2020, which obviously included the shutdown, the pandemic, et cetera. More than 70 debt deals have been postponed or canceled in 2022, data compiled by Bloomberg show. That's compared with 37 during the full year of 2021 and 67 during 2020. So we're seeing a seizing up, a slowing down in this sort of economic machine associated with the ongoing advancement of private sector leverage. That process slowing down and grinding to a halt, which we can observe across a lot of economic statistics in real time, in near real time, is obviously something that's going to remain ongoing as long as we remain in this growth cycle downturn, which our model suggests should continue to gather steam into the early part of next year. Into and through the early part of next year. We agree to disagree. We disagree to agree. Have you ever heard anybody say that? Well, if not, I'm making it up. Goldman said global stock funds face an elevated risk of selling off further as they're still only pricing in a mild recession. Earnings revisions are likely to turn negative in the second half. So we agree with all those statements. The point I'm making is that I don't believe that they're only pricing in a mild recession. We've showed this in our macroscopic reports in terms of the size of the magnitudes we typically see in the changes in financial conditions and the changes in earnings yields out of the market in the drawdown, things like the high beta, low beta ratio that we typically see in non-recessionary slowdowns. We've not even achieved those kinds of declines or those kind of backing up in yield terms that we've traditionally seen in the non-recessionary slowdown. So if we're pricing in a mild recession, we got a lot of more work to do to even price that in. And certainly if we go to a deep recession, we're nowhere near pricing that kind of outcome in. Certainly haven't seen anything yet materially change with respect to earnings and profits. And then lastly, more war crimes equals more sanctions. So don't expect this geopolitical consternation to be resolved anytime soon. Yesterday, we had Russian missile strikes hit an apartment building near Odessa, killing 17 civilians. So the more war crimes Putin and Russia continue to stack up, the less likely it is we're going to see a resolution, a significantly positive resolution in the near term, again, from the perspective of this conflict and the overall sanctions, et cetera, in terms of food and energy supplies. Obviously, Russia and Ukraine are very important to those supply chains. Big movers this morning. Euro US dollar crossed down 0.7% to minus 2.3% month over month on this inflation number. Euro's was overvalued relative to that inflation print prior to this new all-time high in European inflation. We're also the market is also taking that and saying, hey, you're getting new all-time highs in inflation, but we're not necessarily seeing an incremental hawkishness out of the ECB. So the market is testing Madame Lagarde's resolve here. She's going to have to come and get incrementally tighter in order to protect the euro and stop it from going to and through parity. 10-year TIPS yield, that's the 10-year real interest rate as measured by the TIPS market, minus 17 basis points day over day today to 0.5%. It's up 42 basis points month over month. But that's a big move. I mean, the bond market's really starting to sniff out this growth cycle downturn that we've been talking about in our research all year. 1 year, 1 month forward overnight index swap forward rates. That's the market's rate. That's a forward-looking rate of expectations on Fed funds rate. But 1 year, the average of a month from a year from now, minus 23 basis points day over day. So that's at 290 now. We're now sub 3% for the first time in a while, down 8 basis points month over month. So the market is now starting to cut rates a year from now for the Fed pretty significantly, effectively saying, hey, the Fed's going to be successful in slowing the economy sufficiently enough to get inflation down sufficiently enough to be cutting rates a year from now. That's what that signal means. S&P 500 did not like that, though, down 8.4% month over month in the process of getting a 1 year, 1 month OIS down 8 basis points month over month. So this concept that, sort of the market can just sort of have its cake and eat it too, which is, well, we're going to get inflation down and that's going to cut rates. Well, guess what? The only way to get inflation down significantly enough is to go through the path of perdition. That is a significant slowdown in growth, more likely a recession. But again, where inflation settles at on the other side of that process will have significant implications for asset allocators, the bond market, et cetera. But I don't think we're necessarily at the point in the process where we have to really start discussing that in mass. There's still a lot of pain to go through from a risk asset perspective first. U.S. Shifting gears to our volatility adjusted momentum signals and probable ranges. U.S. dollar bullish VAMs still in the middle of its probable range. Gold bearish VAMs still in the middle of its probable range. 10-year nominal treasury of bullish VAMs, that is oversold. Now you're starting to break that lower boundary to the probable range. So now, we got to start watching it really closely over the next days and weeks. This is typically what happens when you really start to breach the upper or lower boundary. It's usually a leading indicator that we have a phase transition in the volatility adjusted momentum signal itself. So we're just going to keep our eye on that. High yield credit spreads, bullish VAMs, still in the middle of its range. S&P 500 bearish VAMs, middle of its range. VIX neutral VAMs, same deal. NASDAQ 100 bearish VAMs, more or less in the middle of its range. Russell 2000, same deal. Bitcoin bearish VAMs, you got exactly in the middle of its range, 13% of upside, 13% of downside. Ethereum bearish VAMs, basically in the middle of its range as well. A lot of stuff in the middle of its range heading into July here, into the 4th of July holiday weekend. Shanghai Composite, that's neutral VAMs, a lot closer to the upper boundary of its range, which is where it's been really for over a month now. Again, it's not letting you get in. Sometimes they don't let you get out. Sometimes they don't let you get in. This U.S. equity market and crypto markets, by the way, they've given you so many opportunities to get out. I've been on this program day after day after day for free, I might add, trying to help you get out. And yet investors still haven't gotten out. So you can be as hard-headed as you want and try to fight the Fed, or you can just invest alongside the liquidity cycle. We can help you do that. WTI crude oil, that is still bullish VAMs, 2% downside versus 16% of upside. Agricultural neutral VAMs still deeply oversold there. Industrial metals bearish VAMs getting even more deeply oversold as the growth cycle downturn continues to get incrementally priced into and across asset markets. So with that, Darius Dale presenting our macro minute for Friday, July 1st, 2022. Everyone have a wonderful holiday weekend out there. We got a day off on Monday, I believe, for the 4th of July holiday, one of my favorite holidays. Happy America's birthday. Cheers.